Of April. Hope you all had a fantastic weekend. Obviously nice and sunny. Summer's here for at least a day. Unfortunately not quite as warm this morning. But Easter weekend coming, so a holiday shortened week, and we'll discuss the calendar ahead for the week, because there's a couple of key points of interest when we look at the next 4 trading days. But first off, just taking a quick recap of the really Friday news, then the weekend news to where we are this morning. And looking at the charts this morning, things are relatively quiet, despite a lot of the geopolitical tension rising at the weekend, and we'll discuss some of the key headlines. But first of all, let's just take a look back at non-farm payrolls. And actually, if you were looking at the equity market, it's pretty tough to actually, without hovering your cursor, to see in the equity market, at least in the S&P, where non-farm payrolls even came out. You know, it's such a minimal type reaction in the equity market overall. Looking at treasuries now, in hindsight, you had that original blip before then yields gradually rose throughout the course of the day. So the US 10-year basically declined all the way through into the close. And then likewise in the currency market, despite an initial knee-jerk reaction lower in the dollar rallied, and consequently euro-dollar pair and cable both trended lower in Friday afternoon session. So it was kind of a classic, or a good example, of why trading non-farm payrolls is particularly difficult, and quite often, especially for inexperienced traders, probably something which is best off being avoided rather than tried to trade the figure. And the reason for this was because, if we just recap the numbers, because of the way the market goes through in terms of reaction in quite an orderly fashion. It always reacts to the headline first. Now this can be a byproduct in terms of the actual reaction of the fact that there's a real lack of liquidity in the market. You see that bid-offer spread really widen out ahead of the figure, because no one's going to be sat in a position when that number hits. And then you get this initial blast of activity on reaction first and foremost to the headline reading, which, as you know now, it came out at 98,000, which, when you hear that number alone against an expectation of 180, immediately obviously that is a big negative, a large miss on expectations, particularly when things like ADP had outperformed earlier in the week. But then you start to break down the report, and after the initial knee-jerk spike, the devil is in the details always when it comes to non-farm payrolls. And then you had a revision which was lower, but only marginally lower. We've seen much bigger revisions than this in the past. But then the unemployment rate unexpectedly dropped very sharply, 4.5% against expected 4.7%. If you look at the key average hourly earnings, although it was in line, the previous was revised up. So these are net benefit there, also with the unemployment rate. And this is what we were discussing at the time of the release. If we look at the actual payrolls headline figure, we were saying that if the headline is very weak, the market almost overlooks it and discounts that one number as an outlier, particularly when there's a very explainable issue of why that figure could have been so weak. And actually, I've seen from Deutsche Bank, they've kind of put a number on the weather impact, which was critical to the reasoning why that headline creation or job creation figure was so low. Deutsche is saying their economists note that 3.1 million people reported that they could not work a full week because of bad weather. When you start looking statistically, with the jump in household employment and the decline in the number of people unemployed, pushed the unemployment rate down 0.2 to 4.5%. That was the lowest since May of 2007. Another very interesting point that I saw, that average hourly earnings, was this is an earnings rank of the 14 different sectors of which the people in the US are employed, and of the green section, these are the upper earnings quartile by value. And actually, if you were to do an average on that, hourly earnings actually rose an average of 0.3% against expectations of 0.2 when just looking at the more high value earnings quartiles. So actually, despite the headline figure, which can be discounted because of the weather one-off impact because of Winter Storm Stella, actually the underlying metrics are pretty good. Hence the reason why after that knee-jerk reaction, and this is why always you need to hear the entire report of non-farm payrolls, otherwise you will for sure get caught in that initial noise. And then the prevailing trend here was actually fairly clear. It was actually a good report, and when you look at the 3-month headline average, despite that 98k, we're still tracking up at 178,000, which albeit is still relatively high in historical terms. So hopefully that explains the kind of non-farm situation, just recapping that and the way the markets really took a much more positive spin all the way through into the US close, particularly in the dollar and US yields. You can see despite that initial jerk higher that you had in US 10-year, we just continued all the way back down. We went almost a full point from that initial spike high to the low that we hit. Okay, so let's go through some of the weekend press. And certainly following the movement that we had at the end of last week on that US authorization of those airstrikes on a Syrian airbase, that's really dominated the weekend news coverage. So having a look where the US have ramped up pressure on Russia over Syrian conflict. So Washington has ratcheted up pressure following that, with senior US officials saying the problem in Syria was Moscow's sponsorship of a murderous regime. So tensions between Moscow and Washington having escalated following that incident. Rex Tillerson, US Secretary of State, who's due to meet Putin on Wednesday, said that Moscow had failed in its commitments to prevent the Syrian government using chemical weapons. So there is a meeting forthcoming. The US Secretary of State is still going to carry out those meetings despite Boris Johnson not going ahead and doing it, which is obviously annoyed the Russians if you were looking at the commentary in the news at the weekend and the things that they've been saying about the UK basically sitting in the shadow of the US not having any political power at all. That's what the Russians have been saying about Britain. But certainly this is an ongoing situation. We discussed this at the end of last week about the relationship between now Trump and Putin, which was all sunshine and rainbows almost when they first got together after he won the election back in November, but now this has severely dented those hopes of a kind of a peaceful compromise between the two nations. This as well has also escalated the kind of geopolitical tensions. You probably read about that hours after the US fired those missiles in the Syrian airbase, the White House was quick to say that strikes sent a strong signal not just to the war-torn Arab state but to the rest of the world. So essentially over the weekend the Pentagon have deployed an aircraft carrier group to the waters near the Korean peninsula in a move a US military official has told the FT was designed to be a show of force. But obviously this isn't just about showing force to North Korea. You're obviously going to have to go into waters that are heavily policed by both China and Japan. And given the ties that the US has with Japan and the relationship between Japan and China, this is obviously going to get very interesting when you sail in a fleet of US naval ships into hotly contested waters. So this is also something that is ongoing at the same time. Wrapping up the headlines, what's Russia and Iran? Because if you remember when we were looking at the way that geographically all those countries are aligned and how that kind of equates into the politics, Russia and Iran warn the US that they will respond with force if red lines crossed in Syria again. So obviously Trump and the action that he's taken thus far, I'd say, has kind of split a bit of opinion. Some, I'd say majority, are saying that he's actually defining himself as a bit more of a president, and his policies in taking a lot more forceful action than the previous administration in a lot of these more contentious issues. And certainly though the response that you get from the likes of Russia and Iran will be the one, or the key areas to keep an eye out for. So anything on those issues, or especially commentary out of the likes of Putin, I'd say coming out just as headlines and Twitter and so on, you will need to keep an eye on. If you were looking at the Asia Pac performance following that news about the US naval ships sailing into the North Korean peninsula, then actually the Korean exchange, which is the KOSPI, is their main stock index, underperformed in the Asia Pacific session overnight. I think it was down about 1% when I last looked, and the cost of hedging in the Korean won losses spiked to a 9-month high. You can see here the immediate North Korea have always been pretty active in talking quite a big game when it comes to ballistic missile tests and so on and so forth. The verbal rhetoric is quite a regular theme. However, now that this is being met with an actual physical response by the Navy of the US into that troubled zone, actually you're starting to see some real actual market movement into protection against volatility in that currency. So certainly a situation to watch in the coming days. If you were looking at, and I know my own brother actually bought a number of these stocks after Trump got elected, and I think after a bit of a nervous period in this Trump trade around December, the actual defense names have now started to rally again, as all this has started to kind of, I guess, geopolitical risk has become elevated once again. If you got into those positions in Raytheon, Lockheed and Boeing back when Trump won, you're sitting in a fairly nice position at the moment across a lot of these stocks. So these defense contractors and suppliers of military equipment, obviously it was 59 Tomahawk missiles that we used, I think it was on the Syrian airbase strike. They were all made by a company called Raytheon, and their shares rallying quite sharply on the back of that. Lockheed Martin's the world's #1 weapons supplier. Their shares also lifting quite aggressively. Obviously, if you look at Trump and his budget proportions and where he's allocating most spend, defense is massive compared to every other area of his policy. And so these stocks benefiting all on the back of that. So if you're looking at a single stock play, you're probably maybe a little bit late to the party, but depending on where this, how far these tensions escalate to, you would say that there's probably a little bit more to go in that play going forward. Okay, quick look at some of the asset movements that we've had so far this morning. If I quickly just look back at oil, oil is trading above a 52 handle this morning. If I make it a bit more longer dated chart, you had back on, well, this was actually, if I highlight it, this was the Syrian strike that happened, so I've just circled that on my chart. If we get any higher, you're looking at the Asia Pac high. The reopening of electronic trade was seen at 62, so within the 10-cent range of that at current price. And then that R1 pretty much marries up with that Syrian airstrike high and the $53 handle. So definitely I'd be keeping an eye there on the upside should we get up to that point. We'll see, start looking at a $53 handle. If my daily continuation chart loads up. Then technically, really after 54, 55, 24 marks, then you're looking at the high points from really toward year-to-date highs, and then would have been late, well, right at the beginning of the year, 3rd of Jan, we printed up at 55.24. So really sharp about turn that we've had after that brief kind of panic about an emphasis on US output. Even though that story is continuing, it's almost as if now the geopolitics has overtaken that and become the overriding theme once again. The other thing, of course, that people are watching out closely in the crude market is about this situation about Russia. And you've had the Russian energy minister Novak. Russia has been in talks about prolonging reductions. So Russia seems to be just warming up a little bit from an oil management point of view as to what a lot of those OPEC nations have been calling for, which was a further extension to those cuts which are expiring in the summer of this year. So you can see here when OPEC agreed to trim output, that was back on 30th of November of 2016, you can see the market was already rallying into that event as we started to get compromises between Saudi and Iran, which would have been the first real 2 times that those countries have seen eye to eye on such an agreement since I think it was the financial crisis. We rallied since then. We dipped on this US output theme that I just spoke about, and now we're rallying back up above 52. So just keeping an eye really top end of that recent range towards the 54 on the longer term play. Rig counts, talking of US output, just so you're aware, US oil rig counts were up again. This is now the 12th week in a row. The oil rigs are coming back online, so up another 10 to 672. We're now at the highest rig count in the US since September of 2015, to just put it in a bit of context. Okay, just quickly moving away from or onto different themes, talking about Fed policy. One of the big things from last week now that people are looking at is about this idea of the reinvestment policy, i.e. the tightening of the balance sheet. When is that going to happen? Is it going to happen in terms of this interest rate cycle of increases coming up with another 2 more rate increases for 2017? At what point do the Fed start to tighten the balance sheet, which would act as maybe a dual force then for the tightening of policy out of this or more accommodative period we've been in? And this is a chap that you should be very familiar with seeing. This is James Bullard. He does tend to like the sound of his own voice. He is a very opinionated fellow and tends to be quite outspoken about his view on monetary policy, usually much more so than these colleagues at the Fed, I'd say. So he said the US Federal Reserve could begin winding down its massive balance sheet sometime later this year in a shift that would make it less necessary to raise the official funds rate. So talking to reporters in Australia, he said opinions differed within the Fed though on ending its balance sheet reinvestment policy, and it would take some time to agree on, but he felt it could start later in the year. So that's what I'd be doing here is I don't think this is having a direct implication for market prices right now today, but obviously listening to these subtle changes and hints towards timelines from various members will ultimately give you better positioning then to interpret these comments from Fed speakers as and when they happen. Okay, moving over to France, there's been a few subtle developments here as well, as it's now, as we really saw last week, is evolving into a 4-way race now for the first round, as Mélenchon has surged and it's continued in recent polls. So what's happened here is that a Cantor Sofri poll from the weekend showed Macron and Le Pen tied at 24% in the first round. However, Mélenchon has now seen his support rise to 18%, putting him 1% ahead of Fillon. So Mélenchon's support is now up about 6% from mid-March. Both him and Fillon both had campaign rallies, I believe it was on Sunday, so over the weekend. But he has seen his popularity surge in some of these recent polling, and certainly not a foregone conclusion then that it was only between really 3 candidates or really 2. If he continues at this pace, could he knock Macron off his perch of being the kind of go-to guy in the runoff against Le Pen? I'd say that's a little bit of a bold call. I'd say Macron's still very much the favourite to go through against Le Pen. But I would definitely be keeping an eye on this kind of mix of the front runners as we get closer in toward that first round. It's kind of sneaking up on us. We're at the 10th of April now, so realistically we've only got another 2.5 weeks until we get that first round result. Okay, a quick look at the calendar today, and then I'm going to hand you over to Will, and he's going to have a quick chat with you guys as well on the mic. So looking at today's session, there is not a great deal on the calendar for the intraday. This is quite typical of a Monday, but you do have some speakers coming out. ECB's Constancio to speak in Brussels at 2 o'clock this afternoon. Janet Yellen does speak, but not until well after European markets close, in fact at the close on Wall Street this evening. So Fed labour market conditions, you've got employment trend index coming out later this afternoon at 3 o'clock. Maybe keep half an eye on there, but really not a great deal to really spark activity, I'd say, out of this. And so I think you've just got to look at the market accordingly. As you can see from the charts and the setup this morning, it's been fairly quiet. There's not a great deal going on. A lot of geopolitical noise in the press, and that's something to be monitored going forward, as well as those other kind of macro themes that I just spoke about. But if we have a look at this is the weekly calendar in its entirety, and this will probably give you a bit more clarity of where the peaks of interest or volatility might well occur this week. And for one, most of the US and European markets will be, well, the floors will be shut. There'll be a reduced electronic trade as we run into the Easter weekend. So you do have US CPI coming out and retail sales from the US on Friday, but the markets will in summary, will be closed, as too will we. So let's just X out Friday. Looking at Tuesday, again pretty quiet. Main focus here though is going to be on the UK inflation situation. Obviously market participants, sterling traders, monitoring that very closely in the FX market for the speed in which inflation is ultimately rising, because we know directionally it is going up, and that will define then the kind of response, if any, from the Bank of England in terms of commentary. Going into Wednesday, we then get the UK jobs update situation. I'd say that's lesser important. The employment situation in the UK is actually fairly good at this present point, despite Brexit. It's really the inflation readings that really globally for all central banks is the key issue at the moment. You do have the Bank of Canada interest rate decision though for any currency traders on Wednesday. Thursday, you've got the University of Michigan. This is the preliminary, so more important reading. And you also get some final CPI readings coming out from European nations. So really, Tuesday for FX sterling and inflation, Wednesday then for CAD FX, but overall not too much coming out. The one thing that no one's really spoken of but is occurring this week is it's US earnings season. And so JP Morgan, Citi, Wells Fargo, they're the traditional kind of bellwethers for the banking sector, which marks really the start of earnings season. They're all reporting on Thursday. So JP, Citi, Wells Fargo, they all normally report before the opening bell. That will be another kind of macro theme just to be monitored. But I'd probably say earnings season, there's a reason why no one's talking about it. I don't think people are really too fussed when there's bigger, broader macro themes upcoming, which are probably more higher up the hierarchy of interest for the market. Okay, quick article here on volatility. I'm going to hand you over to Will, who's going to talk over that with you. So have a good session, guys.
Thank you very much, Anthony. Hello, everybody. I hope you're well. Yeah, I just wanted to, just reading something in the FT this morning that I thought you guys might all find interesting, especially if you've been really trying to short equity prices on the assumption of the geopolitics being reflected in an equity market move lower. And I guess I'm quite keen on this because, you know, I was frustrated a little bit last week in the lack of response to any of the geopolitical events. I mean, for me, as far as I saw it, as soon as the American planes, 15 or 59 missiles, I should say, hit Syria, it wasn't that event that really caused me concern. It was much more the event of, well, what's now going to happen with the relationship with Russia? And there's a number of ways to look at it. One thing that I find interesting, just talking about Russia and the reaction at the moment, whenever in the past you have seen a terrorist event in Russia, there has been a very swift response in some way, military response or a campaign, whether it's in the Caucasus or whatever region they think is perhaps responsible for the terrorist activity. But you haven't seen anything from Russia yet after, I mean, it was only a few days ago really that we had the attack in St. Petersburg. Anyway, just to remember that in terms of the context of what's happening in global politics at the moment, and geopolitics certainly. So what this article is saying is that for all of those of us that are trying to equate global instability with perhaps an opportunity for equity prices to correct these phenomenal levels, we have to be wary because of what this article is saying about the VIX. So as a reminder, the VIX is a volatility index that traders can buy if they feel that we're going to see a heightened period of volatility across financial market assets, most notably the S&P, or traders can sell it if they think, if there's been a quick correction, much as there was at 2 a.m. on Thursday morning. If there's been a quick correction, then equity markets can sell the VIX, assuming a return to normality in the S&P very quickly. And that's exactly what's happening this year. So markets are incredibly tranquil, and one of the reasons is that there's many traders out there who, whenever the VIX starts to rise, whenever you see a slight pop lower in the S&P, large groups of traders are shorting the VIX. They're shorting vol. And by shorting the vol, really effectively what they're doing is reducing then the volatility across equity markets whenever there's an opportunity to do so. This strategy would have made you returns of over 500% since 2011. Whenever there's been a bout of volatility, if you've gone into the market and short that volatility on the assumption that actually equity markets will continue to grind higher, stability will continue to prevail, and this would have made you 500%, which has been really fantastic for many funds globally, because whilst they've been long equities, whenever there's then been a pop in volatility, they've gone short that volatility and heavily increased their returns. So is that understandable to everybody? You have this thing called the VIX, and over the last few years, whenever there's been a overnight sell-off on the S&P or whatever, there's been a few days of market concern, traders have weighed in and shorted this volatility index, profiting then on a return to equity market stability. And then any sharp moves in equities has really been snuffled out quite quickly, and you can see that. You can see that by the way, just looking at the chart yourself. But what this journalist is saying is that, well, my fear is that we might have a 1987 style event here. And this is referring to the Black Monday crash that was exacerbated by a trading technique called portfolio insurance. And what he's saying here is that all of these traders are getting short the VIX and getting short the VIX, and for the last 6 years that's been a very profitable strategy. But what might happen is, if there is a geopolitical event that does finally create volatility, if we finally do get volatility, that's a huge if, but if we do get volatility, then the market might have a problem. And the problem is this: you've got billions of dollars all around the world that are short the volatility. And who can tell me, what would you do with stocks to hedge against a short VIX position? What would be the trade? What trade would you do with the S&P to hedge a short VIX position? You're short the VIX on the assumption of what's happened over the last 6 years. Markets come down and calm again and start to grind higher once more. Let's say that strategy doesn't work and the VIX really does pop higher. Just type it in the room. What would be the strategy in the S&P? Would you buy or sell the S&P to hedge a short VIX position? Just type it in the room.
Buy S&P.
Type it in the room. Okay, yeah, that's right. Hard to get you guys to actually type in this thing. No, do type and get involved. It really helps the conversation. I really want to see you think. Well, you would short the S&P. You would sell the S&P to hedge against your VIX position. Okay, so a few of you guys there are saying long or buy. So it's important to understand this. If you've gone heavily short the VIX and now you have a position in the volatility index that you can't get out of, it's not liquid enough and you're losing a lot of money, the one way you can protect yourself against the VIX moving higher further, therefore, would be to short the S&P. And this is what he's referring to the 1987 event in terms of what you're going to have to do in order to, because everybody's lumped into one trade on the assumption that there'll be no volatility. In fact, that hedge itself will further create volatility, if that makes sense. So it's something, this article I find very interesting. because I think what is happening to, you know, the sheer calm across risk assets, where you have, you know, large global powers really beginning to square up at one another. And given what's happening with Russia in terms of, you know, Putin now, the Russian economy not having done so well, Putin would, a small war would be perfect, wouldn't it? To repatriate their supporters. And if you feel like you're losing political power, as Maggie Thatcher did in the Falklands War, I mean, this was a great strategy, start a war. Get everybody behind you. At the same time that Brexit is going on, at the same time that now we're, you know, I can only see this situation in the Middle East escalating. It's weekly now. We're having terrorist atrocities, and the reaction from the West. What? I've got another idea, by the way. Just sorry, I hope I'm not boring you, but one other thing to think about. Let's talk about Brexit. As far as military power is concerned, Europe has very little indeed. In fact, the largest military presence in Europe is the UK, closely followed by France. It's really the UK and France that have any type of military weight whatsoever. And I wonder if what's happening now with Russia and geopolitics might actually be a very good thing for Brexit from the British point of view. Can you think why? Because what card does the UK have that the rest of Europe, apart from France, really doesn't have? Well, we do have a military presence. We do have capability in our armed forces. Defence, the UK, if you look at Europe and you compare the UK's defence compared to anybody else outside France, then the EU does not want to alienate the UK at this moment, defence and intelligence. So from a very selfish British point of view, perhaps an escalating and uncertain geopolitical environment might actually give Britain some leeway in terms of discussions with the EU. At this time, it's definitely perhaps not an idea to alienate the biggest military defence capability within the bloc. Just an idea. Okay, moving forward then, I want to talk a little bit about psychology. I want to talk a bit about some of our traders here at Amplify who are going live for the first time today, and talk about the challenges on that. So please do listen up, all you new stage 3ers out there. There's no rush. I know it's going to feel like there's a ticking clock on your live trading with us, but it's, you know, we do back and continue to support people that finish up in their account at the end of stage 3. When you finish up in this account isn't necessarily what's important. So what I'm trying to say is you don't have to try and hit the ball out the park today. And when you are in a profitable trade, you don't have to go for a home run. Obviously, we've talked about this all throughout your training, but I can promise you what other stage 3ers who are now still with us would advise you certainly is small and steady. If you can start to book profits when you're in those trades, if you're in a trade of 3 or 4 contracts and you can be relative, especially with this volatility, relatively quick to book some of that profit and just notch up a series of small updates. It's not the P&L that makes the big difference, but it's your psychology. You know, the huge black and white difference here is somebody that starts off in stage 3 and tries to force the market and doesn't take profit when it's there, so feels like they're then forever catching up and they're forever then running uphill. The mindset, it's not just the fact of running uphill, it's the mindset difference that changes. That means that when there is an opportunity, or when there is an opportunity certainly to stay out, that trader behaves differently. Compare that to somebody who for the first week has 3 up days, 1 down day and 1 flat day, let's say. As a first week, not necessarily enough to write home about, but think about where their mindset might be then when they start on week 2. You know, they've been active, they've been able to take responsibility for their decisions, and when then an opportunity arises, they can take advantage of it. So in terms of P&L, the new month 3 traders, it's not about trying to make as much money as you can immediately, straight away. What I really and seriously want to advise you is treat your own psychology like a small flower, like a small bud of a small tree. You've still got a huge amount of growing to do, and what you need to give to help that growth at the moment are the nutrients, are the nitrates, the soil, it's the water, it's the sunlight, it's the air. And all of those fundamental attributes come from time in front of the screen, taking responsibility for the decisions that you make, and making sure that you're giving your own psychology all of what it needs for growth. Okay? That is definitely best achieved by looking to book small up days, nothing too crazy. Definitely avoid, if you can, hitting your daily stop, even if you're sure that you can make it back, just in terms of your own psychology. For this first week, if you go halfway towards your daily stop, call it a day. Breathe and come back tomorrow. But more than anything, guys, I want to wish you good luck. Welcome to the team. Happy to have you trade with our funds, and look forward to seeing how you get on. Okay, that's it. It's going to be an interesting week. So much going on. I can promise you your access to trading live. And for you guys in stage 3, remember, trading live, whether you continue with us or not, it's accessible to you going on after this program. So try and get as much use of trading live as you can as possible, because having Anthony here on the desk with all of his resources and access to the news when we're getting geopolitical events, hopefully you'll see just how invaluable that is. Okay guys, that's it from me. Have a good session, and I'll see you in the room. Good luck.